number and take it out, put it in the ending number. Yeah, that's your first adjustment. Is to
How
adjust.
come it says adjustment instead of ending?
On what?
When you put the amount in merchandise inventory under the debit side, shouldn't it say ending instead of adjustment?
I don't. What page are you on? Because I'm not sure what you're talking about.
401 at the very bottom.
401. Merchandise inventory. We're adjusting it. Your first, in your accounts, you write the word adjustment to show that you're adjusting that account. But in your entry in your journal, you would describe it as to adjust, to take out the
Merchandise.
beginning inventory. Right? This is just showing you how you do your adjustment. You're adjusting it by taking out the beginning and putting it over there in the income summary, right? And then you're adding the ending. So you're adding it to your merchandise inventory. So So now it's showing up as the balance in there. And then it shows up in the income summary on the credit side. So the difference between those two numbers in that income summary account now gives you the cost of the goods that you sold, right? You know, the ones that are no longer there. So, and we use that number. We need that number for the beginning and for the ending in order to do our income statement, where we show the different things that happened in order to show how much we sold and how much it cost us, the goods cost us that we sold. Yeah. Okay, so let's look at this. And remember, when we're talking about revenue, revenue is recognized. Anybody know what the word recognized means in accounting?
Written down.
Written down. We recognize it, meaning we earned it, right? It's going on our books. Whether or not we get paid for it or not, it doesn't matter. We earned it. Just like you earn your paycheck, right, when you go to work, whether you've got the check in your hand or not, you earn that money. Legally, it's yours. Okay. Same thing when we do a sale or perform a service. So, we recognize it when we earn it, not necessarily when the cash is received. So, when we're in sales, we have earned the revenue when we give them the merchandise and they pay us. Or they do an accounts receivable, right? Either way. So when we complete the work, the sale is complete when we hand them the merchandise, basically. Because they got it, right? They've got the merchandise. We've made the sale. Okay. So when the title passes hands, when they get it, or when we've completed the service, we've gone over there and done their accounting books or whatever, worked for them for a couple hours, we earned that money. Okay. All right, very important. So we recognize it when the sale occurs or when the service is provided. Also, expenses are recognized when we incur that expense. Same way from the other side of the track there, right? They've earned their money when we created an expense, either gotten something, bought something, or they've provided a service for us.
Like a utility bill.
Or the utility, exactly. So, expenses are incurred when we use it or incur it, not necessarily when we actually pay the cash out. So, it shows up as an expense in this period, whether it's actually been paid for or not. Very important in our accounting principle of matching. We match expenses for that period to the revenue that's being earned during that period of time. So if it's 30 days, then we're matching everything that happened in that 30 days that could be counted as an expense to the revenue that we earned during that period of time. Okay, so this is real important. As you go through accounting, you see we go deeper and deeper and deeper into finding any little thing that could be counted as an expense during that period. Okay, in this class we're pretty general about it, but as we keep going, the whole goal is to just see that when you get into accounting 2. We go a little deeper into finding these expenses. Right, because we want to lower the tax rate at the end, right? Okay. Jimmy, are you able to hear me okay, just talking naturally?
Yeah.
Okay.
Yeah.
Good. So it's matching revenues to the expenses. Doesn't mean they're equal. That match doesn't mean that. It means matching the period in which they're recorded. Okay. So in order to first adjust our merchandise inventory, during the month, remember, we don't do anything to the inventory account. When we purchase goods to resale, where do we put them? We don't go to inventory and record them. We put them where?
Income sum purchases.
In the purchases account, right? That's what you've been dealing with. Anything you bought that was bought on credit goes in the purchases journal. If you bought merchandise for resale and paid cash for it, it goes in the cash payments journal. Under purchases, it'd be listed as purchases over there in the other account to show that it's more stuff we bought to resale, but we paid cash for it. So, what if you buy, I hope this rings a bell with some of you, what if you buy merchandise, stock merchandise for the stock room, supplies for the stock room? Is that merchandise for resale?
Yes.
No.
Oh, it's supplies used.
Any kind of supplies. Let me read you an example of one. Hopefully it rings a bell with some of you. Out of Critical Thinking 9.1 problem that you did. Critical Thinking 9.1. I'll let you look at it because I'm not going to give these out for you to go over until everybody's here. Or I'll give them to you. Y'all can take them and look at them, but I need them back. Because I'm not accepting any more 9.1. I guess you can get them, yeah. Hang on a second. Let's look at, yeah. But Jimmy doesn't have hers. But that's okay. Yeah, y'all can get yours. 9.1. And that's on page, here, let me. I was pretty lenient on the grading on these. Everything is marked. My grader went through and marked every single thing, even the wording on how you did your descriptions, which does not count off whatsoever. However, how you have it worded is fine. But she wrote everything in off she wrote every single thing that wasn't exactly like the key. So don't worry about the wording. It wouldn't have been counted off for anyway. As long as you had the information you needed on there for your description of you're fine. Okay. So let's look at 9.1. It looks like it's bleeding, doesn't it? All of them do. But it's not. I didn't count. She just wrote it in there because she thought that's how it's supposed to be, but it's because she hadn't had a counter. I know. These are dead. So let's look over here just quickly because I want to mention this because we are.
Is it September 8th?
Yeah. On September 8th, you bought store supplies. And so that store supplies are not purchases for resale. It would merchandise is what you buy to resale. Okay? Store supplies are just like regular supplies. So they needed to go in the general journal, that entry did. And I had a couple of people that caught that, didn't put it in there. So, okay. That was the challenge part of the thinking part of the critical thinking. Is I think that was just maybe the one thing that they wanted you to think about and catch. So anyway, but now you know, and I really didn't count off that much for anything. If you did throw off 2 of your journals. Threw off your purchases journal and then but a lot of you did not post to your general ledger accounts or show your correct posting references, and some things got posted to the wrong thing. And so you might want to, if you want to, go back through and take a look at it and see. If you want to go through step by step and just see what, and if you have any question over it, where one should have went or what, just you can ask me about it. Okay. All right, so back to it has to be merchandise inventory, right? It has to be merchandise inventory to go in the purchases account. So we debit them all to the purchases account if we're doing it during the month. So our merchandise inventory is sitting there with the beginning balance, the balance from the beginning of the month, right? That's what it started with, and we don't do anything to it during the month. So at the end of the month, this is where we go out there and count, see what's left out there, and that's when we adjust our merchandise inventory to show the end of the month account. So this is when we do this adjustment. Okay. All right. Okay. No entries are made directly to the merchandise inventory account during the accounting period. So therefore, it's going to show the wrong balance in your merchandise account. All right. Okay. So what we do is we do the 2 adjusting entries first. We adjust. We take out the beginning inventory out of our merchandise inventory account. We credit the merchandise inventory account since it is an asset account in order to zero it out. And we move it to our income summary account. First adjustment. Then the next adjustment, they went out there and they counted and see how much was left. So then we debit our merchandise inventory to show the amount at the end, and credit the income summary account for that amount. So that, well, that's all you have to do. That's just your first adjustment, is to adjust your merchandise inventory so that it's going to show the correct ending balance. Okay.
Now, income summary is a liability or an owner's equity account, right?
It's an owner's equity account, right, that we use to use during at the end during closing. It's the only time that account is used, is during closing process. Okay.
Why don't they just subtract 5,000 out of the merchandise account and make one step?
Because we have to show that we have to use the beginning inventory and use the ending inventory numbers, and we have to show that we took out the beginning and what it was, and that's the reason. It just has to show that whole process. You know, they probably could by adjusting it because this is this, but they want it to show because, for one thing, these 2 numbers are carried on across the worksheet, which you'll see in a minute. We carry them across to do something with those numbers later. Okay, so what about the other things? We've talked about some of these. Uncollectible accounts. And that's one we have not dealt with. That's another new one. And we want to know, we've talked about this, about accounts receivable. Does everybody pay?
No.
No. So, in accounting, our goal is to never overstate income, right? So in order to not overstate our